Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. Today we are looking at Edwards Lifesciences. This came in by request in one of the comments in the comment section of either an article or one of the YouTube videos. If you have a request that you would like me to analyze and it's in the S&P 500, I will put it on my list and make a free YouTube video. If it's not in the S&P 500, over on Patreon, I post those. That's only $5 a month. And then if you join Patreon, you get a big discount to my full service, which has all the spreadsheets. You can chat with me. I post a lot of extra articles and stuff there. And I have more strategies than the ones that I usually cover on YouTube. So check those links out in the description if you're interested in those or you have a request that's not in the S&P 500. And with that, we'll just move on to the analysis here. This isn't advice. This is just how I analyze stocks. If I'm looking to buy something or if somebody asks me about it, this is the process that I go through for this particular type of stock. All right, let's take a look. I like to start off by looking at any past coverage I've had because I don't usually tell a lot of stories about the business. I usually start with the numbers first, kind of how that fits in with maybe the macro of what's going on. And then right before usually I get ready to buy something, I'll look more closely at the business to see if there's like something important that I'm missing that's not showing up in the numbers. So I first wrote and covered Edwards Lifesciences over on Seeking Alpha January 24th, 2020. So this would have been right before the pandemic. That was a sell rating based on valuation. Let's see how it's done since then. So since then, the stock is down 9% and the S&P 500 is up about 30%. So that looks like a good sell call to me. And there wasn't any business reason for it. It was just that it was too expensive, which I'll probably talk about here in a minute when I look at the fast graph. Now, since then, I've written two more articles. This one came on the day the market bottomed in March 23rd, 2020. And I said, here's the price I'll start buying Edwards Lifesciences, which is actually probably going to be the title of this video because the price has been coming down. So it's getting interesting. Usually I write these, here's when I'm going to buy, when it's getting kind of somewhat close to a price I would actually buy it. Now they've had a stock split since then. So split adjusted, I went and read this article. I'm not going to dig in, pull it up, but split adjusted, the price I was looking to buy it at that time was $45.66. It did not hit that price, probably obviously since this is the day the market bottomed when this came out. But it did get pretty close. It got down to $51.50, so I needed $5 more lower, or 10%, we'll call it lower. And I would have been a buyer right at the bottom. So it was pretty close to hitting my buy price there. Now you can look at kind of what it's done since we've had this gigantic run up where it was really expensive, and then it's come down. And I think I wrote about it this year. I thought, let me see if I can pull that up again. So this one I looked forward like 4 years, and that was just earlier this year. So I didn't really cover it in between these times. Probably because it was like super expensive. It just wasn't very interesting. I already had that sell call on. So, and when I reviewed this, I was looking for flat returns wherever it was over 4 years, wherever it was trading at March 30th. Now earnings have come in a little bit slower than average. So if that continues, then it probably will be negative instead of flat. But it's just a valuation estimate back then. It was still a hold. So I didn't think it was like super expensive. Let's see, when was that? March. So yeah, this would have been right around in here. Now, if I would have written on it back here, it certainly would have been a sell, I'm sure, based on valuation again. So I've done pretty reasonably well at kind of just the basic valuation on the stock. So now if we look at the history, the first thing I always check is the earnings cyclicality. That's this dark green area, earnings per share on the fast graph. If I shorten it up, this is basically a secular growth story for the past 20 years. Great business to own. especially if you bought it a little earlier on before the market kind of really started pricing in the expensiveness in here. So if you were buying down in here, that would have been fantastic. And they had flat earnings in COVID, which that you just throw that out basically for a company like this that's they're in like heart valves and things like that. So you can imagine people were not able to maybe do some of those surgeries or not as many, or so you, even though wasn't even negative still, you couldn't ask for more steady growth. Now what happened over this time period is the market really placed a premium on business. These are pretty rare. I bet there's less than a dozen large cap businesses that haven't had a negative year in the past 20 years. Even recently, like Meta and Alphabet, they've had negative years, and before the past year they hadn't. So it's very rare to have earnings that are this steady over such a long period of time. And investors really placed a premium on that. Obviously, here they really, when they were paying almost 60 PE for the stock. And none of that has really changed. You probably won't be growing as fast as they were back here, but it's just not cyclical. So it's perfectly fine and pretty easy, honestly, to do a valuation on stocks where earnings don't fluctuate a whole lot. It's really then just a question of how long do you think they can keep doing it. So the next thing I like to do is choose a time frame. When there's not like really ever a downturn, you can just kind of pick a time frame. I mean, we haven't had, even if I went back to before the recession, like the 2008 recession, they grew earnings through that. So it doesn't really matter a whole lot where you start, but in this case, earnings growth is a little bit slower more recently. So I bias a little bit more toward recent data because it's more conservative, right? So a lot of times you'll see me start in 2015. When I looked at my notes, that the last time I did it, I had started in 2016. That's probably just to be slightly more conservative. That takes away 30% growth year, but there's still lots of years, 1, 2, 3, 4, 5, 6, 7, 8. So we'll still have 8 years. There's still some fast growth in here, and then there's also this more subdued growth. Still really good growth, but not as fast. So when I calculate the earnings growth rate for this time, I do take into account buybacks. They bought back about 6% of the stock. So that gives me I didn't look at what. So FastGraph has 1575 as the earnings growth. They measure point to point here, which isn't going to be too different than mine, I think. I'm at, almost exactly the same. I mean, 15.38. So this is basically just those buybacks that I controlled for here. And if you look, I always just look to say, look, does this kind of make sense? And if you look at what analysts are expecting the next 2 years, now they could be wrong. I'm sure they've been wrong before, but you just want to see if you're in the ballpark. And 15 compared to 14 and 13, they don't have to beat by very much to hit that. So I think that's just a reasonable growth estimate going forward. One thing we might want to consider is demographics. If aging boomers kind of pushed up these heart replacement or heart valve issues a little bit more, and if that's going to maybe decline a little bit, I think that could be a potential issue. But I don't think like the weight loss drugs and things, I would take the other side of that. I think that's getting overdone probably. I mean, you never know what's going to happen, but I would definitely not be selling a stock like Edwards due to that. I would have no problem stepping in and buying this stock at the right price, based on those worries. So it could create an opportunity, hopefully, maybe to buy the stock at a good price. So yeah, like 15% earnings growth is what we're looking at. And so the next thing we want to look at is the earnings yield. So we have our growth rate. We want to get our earnings yield. I look at the forward earnings. So we're almost there. This could still change because it's not the end of the year yet. I don't think they've reported this. So they'll probably report pretty soon. And then they'll just have 1 quarter left. So if this is ballpark correct, We're looking pretty good, but I will change it if it actually does change. So I'm looking at $2.55 in earnings. Based on where the stock is trading right now, that is, let me move this real quick and see which PE I have it lined up. Yeah, so this would be the actual PE right now, about 27. And I think FastGraphs has pretty similar. Yep. So we're looking at about a 27 PE. So if you invert that and put the earnings over the price to get the earnings yield, that's 3.75%. Now, the way I like to think about this is if I bought this whole business for $100 and I just kept all these earnings as the owner of the business for myself each year and went and, bought a sailboat or something, they would pay me $3.75 on my $100. And this amount, this $3.75, would grow at 15 point whatever percent it was. So and I pull the first year forward. So the first year I would collect $4.33. Then I would still have that. I would add on the next year, the next year, the next year as it grows. And what I do is I do that for 10 years in this case. So we've almost doubled our money in 10 years. Then the $100 was already there. It grows to, we'll call it 189 or 190. So almost doubles. And I say, okay, what kind of CAGR is that? And that's what this calculates. So that's a 6.6% 10-year. The time frame matters here. I usually use 10-year because you can kind of compare it to bonds, even though stocks and bonds aren't the same. So I think the 10-year treasury bond was 5%. Edwards, if all things happen the way that they've been happening, will produce about 6.6% earnings CAGR. But I use a kind of a standard generic level here. And underneath it kind of assumes like 3% long-term inflation. And so what I like to see to get like a margin of safety and some other things is I like this to be above 8% before I buy it. And I consider 6.5% like the midpoint of fair value. So where Edwards is right now is almost, I would say, exactly fair value given the assumptions that I'm making here. And that's probably why I still have like a hold rating or neutral. I like neutral better because I'm not really holding it because I never bought it. But now the question is, okay, given all these assumptions, when the stock price falls, this number goes up because you're getting more money for the amount you're paying for the company. You're getting more earnings back to you for the amount you're paying for the company. So the question is, it's trading at 68.70 right now. When would it cross 8%? That would be about $53 per share. That's like $8, $7-ish, $7 and change higher than it was in 2020, $7 and change. So it's a little bit higher than my old buy price. Still pretty close to being in range to that. And it's about 20% lower, 23% lower than where the stock trades today, which is, if we have a recession and the market gets jittery or interest rates keep going up, that's pretty close to, it's getting close. And then this other number here, which is pretty similar as the recession buy price, it's going to be about the same because, and I probably base this on 2020 is my guess, it's going to be about the same because I'm not going to go super into detail because it doesn't matter too much for this stock. But for some stocks, their earnings fall off dramatically in recessions. And so I use the recession PE. So when the market, it serves two purposes. When the market's really exuberant before a recession, it helps you not to buy too early. But then also, if it's a company whose earnings fall like 40%, it helps you not basically extrapolate that downward movement like forever, which the market does tend to do, which is why the stocks can fall a lot in a recession. But with Edwards, they just grew right through the last recession, and so the recession PE isn't going to be very different than just the normal price. Now, for some reason, if earnings do fall, a little bit at some point along here. It might be the case that the recession PE is actually a little bit more stable than this, because if earnings fall, this number will go down, and so that recession PE number is a lot more stable. So this might, if I don't know, if earnings fell 10%, maybe this goes down to 40, and the recession PE might actually be higher at that point. And we would assume that they're going to come, earnings would eventually recover. It's not really a economically sensitive stock, I don't think. But interest rates could definitely affect the valuation in terms of other market participants. They adjust. I don't really adjust my my valuations for earnings. One, I don't think it's a good idea to compare 10-year stock yields to bond yields, because we don't know what inflation is going to be. So what I do is just assume over any 10-year period inflation is going to average like 3%, and I kind of just assume that all the time. So if the market gets to if they start assuming interest rates are going to be low for a long time, often I'm much more conservative and I'm sitting telling everybody to hold and sell everything. And then when interest rates are getting higher, like they are now, if they spike to 6 or 7%, I'm still going to assume that over 10 years that they come back down. Where other people are going to be becoming much more pessimistic. So I think it's just a more steady way to do things. It doesn't mean it's going to be right, but it can produce, it can let you have opportunities that other people in the market aren't going to want to buy, because you're ignoring the main metric that a lot of investors are looking at, like the 10-year treasury bonds. So I think that's it. I would definitely be a buyer of this one if the price hit right around this $50 range is kind of where I'd be targeting. I doubt that changes too much until we get into next year. So if we get here and these expectations come down or up, I would be adjusting. So that would be around February-ish. But if it falls 20% next month, or maybe after earnings or something, I'd be a buyer. Okay, yeah, if you like to see more of these videos, you can, if you have a request of your own, put it in the comment section. Don't forget to subscribe. If you hit the notification bell thingy that everybody talks about, you can get updated. I'm going to be putting out a lot of videos. This is going to be a regular thing. So you should be able to get pretty good coverage of the S&P 500 over the next year, probably, just by watching this channel. And then you can get an idea of how I'm doing things here. Thanks for watching, and I'll see everybody later.